Who's having a good year this year? Yeah, it's been a very good year. Now the question a lot of you are probably thinking about at this conference is, what do I do next? Are you going to listen to all of the mining promoters and come to the very logical conclusion that we're only just getting started and we're about to make the most money we're ever going to make right around the corner and you should invest in their project? Or are you listening to perhaps the Rick Rules of the world who are talking about maybe pulling a little bit of money off the table and thinking about how you're going to allocate that going forward? What are you guys thinking? More gold? So this is a question that I started thinking about in earnest in about 2019. And my background is I'm a mining engineer. I've worked in iron ore, I've worked in coal, I've worked in gold extensively. And I've worked with a lot of tremendously successful people in this space, people that I've seen make hundreds of millions of dollars, and then maybe they buy a new car or a new house or a cottage, and then they go 100% back into the next great gold mine, and they're all in all the time. And I've watched them go up and down and up and down. And very few people in this space seem to consistently take winnings off the top. And I started thinking about, who should I be learning from to do this well? And they say to concentrate on what you know. For me, that's natural resources. For me, that's big mining projects. And I started thinking about how the most successful resource investors and entrepreneurs in history had sort of managed this. And so, who would you guys say is probably the most successful resource entrepreneur ever? So, arguably the richest person in human history, known for oil, but obviously how he made his money in oil was first owning refineries, and then owning rail, and then owning pipelines and storage, and really owning that infrastructure that supported that sector. Probably the most successful resource entrepreneurs in modern history. Does anyone know who these guys are? These are the Koch brothers. Together they own at least $100 billion company. It's private, so no one really knows what it's worth. Owned by these two guys and one lucky minority shareholder that stumbled into it with them decades ago. They own, again, they started in refineries, and they started an oil trucking business, and then railways, and then pipelines. Are you seeing a trend here? Does anyone know who this guy is? Dave, I know you know who that is there. So this is Andrew Forrest, an Australian mining billionaire. He started Fortescue Metals. Fortescue Metals is an iron ore miner in Australia. He is worth $20 billion today, not just because of the iron ore mines, but because he also built railways and he also built ports so he could outcompete Rio Tinto to get iron ore to the Chinese. And when you look at all these people, what they really focused on, in addition to the upstream asset, they focused on the infrastructure to get that to market. And if you're in the gold space, you've been spoiled, right? Because it's very easy to refine, and then you just throw it onto a helicopter and fly it to wherever you need to go. But for every real metal that's actually used to build things, it requires ships and not pipelines, that's oil, rail, and so on and so forth. And so this is what we really started thinking about in 2019, my business partner and I. We wanted to take some of the money we were making on these speculative gold, copper, silver plays and think about how to put it into a real scalable business that could be run and grown like a real business and not just a speculation. And we knew we weren't going to be able to go compete with the Trafiguras or the Glencores of the world, people that were spending hundreds of millions of dollars. But we wanted an institutional quality investment for retail and individual investors, which is what we are. And we came across, after 6 years of looking, so we started in 2019 and we really finalized this in 2024, a business that we are calling Cicada Logistics. We bought this. And if that looks like a photo of the least interesting thing you have ever seen, you are dead on. That is called a terminal, and this is specifically a frac sand terminal. And you really want to think of a frac sand terminal like a toll bridge. What happens is frac sand comes in a train, it gets unloaded from that train, it goes out in a truck, it gets picked up by a truck. We never own the frac sand, we don't take commodity price risk, we're not mining it, we're not even selling it to the end user. We are simply a toll bridge. We charge a fee. Every pound of frac sand comes in, gets charged. Every pound that goes out gets charged. It is a very, very, very easy business. And when we started thinking about the kind of infrastructure business that we wanted to buy, we were really only looking for 4 qualities. We wanted to buy irreplaceable assets for less than they are worth. That sounds very easy, and it is very simple, but not necessarily easy. And we were looking for these 4 things. We were looking for price. We wanted to pay less than we knew that it was worth. We were looking for a moat, something that made it really hard to compete with. We were looking for margins. We wanted to be a low-cost producer. And we were looking for scale, something that was big or could be big. And I'm going to talk about what we found in a little bit more detail on each of those things. Okay. Buy irreplaceable assets for less than they are worth. This is the key, because if you screw up the price you buy it for, it's unrecoverable down the road. So this isn't like a gold asset or an exploration project where the upside is theoretically unlimited. It is contained. So you really have to make sure you're buying it for the right price so you can get that profit. It was actually incredibly easy to price this. So we bought this particular asset for about 1/3 of its replacement cost. We paid $35 million. It had over $100 million sunk into it by 2013. So just building this again would be very, very, very expensive. We paid about 5.7 times EBITDA for this. A great, great price, given that most industrial infrastructure assets trade between 10 and 15 times EBITDA if they're in a public market. So we could really quite easily quantify what less than it is worth is. And this is kind of the amazing thing, I think, about investing in commodities and commodity businesses, because every now and then you get these windows where you can just buy things that are so clearly we're like trading for less than they're actually worth. Did any of you guys invest in Silverco by any chance? Anyone here? Any of our newsletter readers? Okay, so we bought Silverco about 18 months ago. Little silver play in Mexico, past producing mine. It was a $6 million valuation. Today it is a $400 million valuation, just 18 months later. And that's an example of something that's clearly less than it was worth when we were paying for it. And when we looked at this asset, it was also a listed asset at one point. It was a single asset company that traded at $300 million valuation on the NASDAQ. And so you get these windows where you can find these things that the market is really not appreciating that. The second part of this is buy irreplaceable assets. So when I talk about moats with commodity infrastructure, I'm thinking about 2 things. I'm thinking about a geographical moat and a geological moat. This particular terminal is in an area that is popular and hard to get to. If you can see the left-hand side of that geographical picture, there's a little bridge that goes over the river. And that bridge is an access point that everyone has to go to. And because we are near that bridge, the only bridge for miles around that river, we are an obvious place to come get your frac sand from. The second and perhaps more important point is geological moats. We are in the heart of the Bakken, where it has the most concentrated oil in place, which means there's going to be more drilling there, and more drilling requires more frac sand, and we are close to most of the drilling. So again, a logical place to buy your frac sand from. And so we were looking at these terminals that are hard to replace and that they're too expensive, and you can't really build another one in a location that has that sort of demand. Next is scale. So this one, I think it was Rick Rule that said to me when I kind of first came to Vancouver, and I was looking at investing in all these little mining companies. He said, small is not beautiful when it comes to mining. And I think that is also true for infrastructure assets. Having scale kind of gives you three things. It gives you a lower operating cost because you're moving more product through there at any given time. In our case, it gives you speed. We have the infrastructure in place so that we can unload a train, a full 150-car train in 24 hours, as opposed to our competitors in the area, which take about a week to do that. And we have optionality. We have a lot of space there, which over the last year and a half has allowed us to bring in other products. So we're bringing propane through, we're bringing diesel through, we're making use of this space. And having that scale was really important to us. And finally, margin. We did a 44% operating margin last year. It's expected to increase this year. This is a huge margin in the commodity business. You know, the average mining company makes about a 15% margin. Why that is so important and what that means is we're a low-cost operator. It means there's a lot of room to make mistakes. And that is a very, very nice thing to have in a cyclical industry. Which brings me to my near end point here, which is actually the question I get the most, which is, why did you name your company after a bug, which is what a cicada is? And we chose the cicada because, if anyone knows this, cicadas are cyclical creatures, right? They dive down into the ground, they lay dormant for sometimes years at the time, and then they come up and resurge. And the year we did this, there was the double cicada cycle where two different cicada groups came up at the same time, and they come up every 100 years or something like that. We thought it was a very good omen to name it after this. And it's a reminder that we're in a cyclical business here, and these factors that I've talked about earlier allow us to have a lot of the upside of these cycles while protecting ourselves against the downside. What was really the selling point for this business for us when we bought it is it was operational during COVID. It was profitable during COVID. And during COVID, as many of you will recall, oil price went negative for probably the first time in human history. And so we looked at this and thought, if it can survive that, this is really one of those robust, anti-fragile projects that can do well in this sort of cyclical sector. And what the result was, so after 20 months of operation, after a lot of work done on management and bringing in cheap debt and improving the business, we did our first dividend this year. We dividended out 28.5%. So if you invested $1,000, you got almost $300 back. You still own all your shares, and we hope to be able to continue this and grow this as the years go on. What's the catch? If you guys have been investing in junior mining companies for long enough, you've probably learned to ask how management is compensated and what the share structure is and all the rest. So we've only ever done one financing into Cicada. Everyone invested at the same price, including ourselves. But what we have is a split. So it's effectively set up like a fund, which is a 75-25% split, 25% to the management, but we have to hit an 8% hurdle every year. So we have to dividend out 8% every year, the 8% hurdle every year to shareholders. If we don't hit it one year, it's 16% the next year, and 24 the year after, and so on and so forth. And then above that, we get a 25% split. So that dividend we talked about earlier, that was after all fees paid to management, etc. And finally, so what we're here to do today, this was our first acquisition, Cicada. We have now launched our second, which we are having the highly original name of calling it Cicada 2, and it has all of the same qualities of the first one. We are paying a price that we think is far less than it's worth. It has both geological and geographical moats. It is a high margin operator, and it has a lot of scale. And so if you've liked what we've talked about today, if this is of interest to you, please let us know. You can learn more about it just by scanning this QR code, and we'll send you everything you need to know if you're an accredited investor on what this new acquisition is and everything we're doing at Cicada. Does anyone have any questions for me? We're a private company, a U.S. company, and I'm a director. Pardon me? Denver, and it's a Delaware-based business. Okay, thank you very much, everybody.